All right, so your next homework assignment, which includes benefit cost analysis problems, and we're going to go through some more of that today. That assignment's due before class on Monday, and we'll continue the trend this morning talking a little bit about some aspects of the project, just to introduce you to a couple of concepts that need to be incorporated into your project thinking, and a few data sources that you maybe could use to learn more and as a reference in your report. And remember, what I've said before is I hope that these references I show you in class are useful starting points, but if you're only to cite the websites that I myself have shown you, then that wouldn't be good evidence that you put independent effort and thinking into the project. So you should use what I show you as just an example of what's out there. Hopefully it's useful, and then find other things as well that explain it a different way or maybe have different statistics to supplement and improve the data that's in here. So one of the parts of your project is to make some assumptions about what rate of return you can expect on your cumulative savings balance. Remember that the difference between the money that comes in to your wallet and the money that goes out of your wallet is by definition savings. Any income that you don't spend is money that you accumulate. And so it has to accumulate somewhere. And for most people with a professional career, some sort of a retirement account is not optional. Your employer will require you to participate in their retirement account. So you'll have some money in a savings account, maybe you'll have some money in a checking account, but a majority of your financial assets will be held in a retirement account like a 401k or a Roth IRA. So it's important for you to understand a little bit more about those different types of accounts and the types of things that you can own in those accounts. Because when you have a 401k account, what that really is it's just kind of like an account with a financial organization, and then you give them money and they buy what you tell them to buy. So 401k is not something that you buy, but rather it's an account where you hold securities like stocks and bonds, maybe certificates of deposits or annuities. So one question that sometimes comes up is, what return could you expect from the stock market? So here's an interesting article from Business Insider where they talk about what has been the average stock market return over the past 10 years. And what they say in this article is that over the last 10 years, the rate of return is 9.2%. So that's quite a lot better than what you could get in a guaranteed rate of return account like a savings account, where the average savings account these days is paying, maybe 1.5%. Now, it's federally insured, which means you absolutely cannot lose money in that account, and you can lose money in a stock account. So there's a little bit more risk involved when you're purchasing stocks. But over the long term, if you have years to make the investment, a long time horizon like you do, maybe 40 years before you're going to need the money, then it's pretty safe that the stock market's going to beat any kind of a guaranteed return investment. So what this article does is it goes through and shows you what has been some of the rates of return on the S&P 500. And there's lots of different indexes that average together different groups of companies, just to give you an idea of how the broader market is doing. You maybe have heard before of the Dow Jones Industrial Index, which is some large companies. There's this S&P 500, which is the top 500 by market capitalization companies that are headquartered in the United States. There are international stock indexes. There's one, I think it's called the Russell 2000, that's including smaller companies. So there's lots of different groupings of companies, and it's a good idea not to just put all of your eggs in one basket. If you put all of your savings into one company and then that company does poorly, then you could really be in for a rough ride. And so what people usually do instead is they'll buy a group of companies, whether it's through a mutual fund or an index fund. There's a variety of different ways to buy these groups. And so in 2010, you can see the rate of return was 15%. Then the following year, it was only 2.1%. So that's quite a fluctuation. And there are even occasionally years where the rate of return is negative, which means that the value of your investment goes down. But the hope is that over the long term, you have more of these years where the account grows by 31% and fewer of the years where the account shrunk by 4.4%. So this is saying that over the last 10 years, the rate of return has been 9.2%. My suspicion is that in the future, things may not go as well as it did back then. You know, that we have a number of new challenges on the horizon that aren't reflected in this data, including the supply chain disruptions you maybe have heard about in the news, where there's container ships just stuck in the ocean because they can't offload their materials. That's going to slow down the economy. There's the effect of the coronavirus itself, the labor shortage. There's the effects of climate change. So there's a lot of headwinds that in the past maybe didn't have to be addressed in the same way they do now. So if you're making your assumptions, you want to be safe, you can assume less than 9.2%. Like if you say, well, I'll put some of my money into stocks and some of my money into bonds, which are secured in a way that stocks aren't. Because when you purchase stocks, you're just now a co-owner of the company, which means that you don't have any guaranteed profits necessarily coming to you, that if the company goes through a few bad years, the owners just don't get money. Whereas people who buy bonds from a company, typically those bonds are secured by assets and collateral. So if the company goes bankrupt, bondholders are going to do a lot better in the bankruptcy than stock shareholders. Everyone else gets paid first besides the stock shareholders. So there's more reward but more risk. So maybe your approach would be to balance, create a portfolio, and the closer you get to retirement, you turn more of your assets over to these safer investments like bonds or even guaranteed securities. All right, so you need to start thinking a little bit about investing. So this is one of the things I wanted to show you is, what does a stock market return average? There's dozens of different articles like this. You could find the average of the last 10 years, over the last 20 years, since the inception of the stock market, and so on. Another link that's interesting to look at is just to begin to read a little bit about what is a 401k. This is on the Investopedia website. So it explains what is a 401k plan and how does it work, what are the annual contribution limits. So I'd encourage you to learn a little bit about personal finance, because you're going to be thrown into the deep end of the pool in 2 or 3 years, where you're going to be sitting in some human resources office and they're going to say, which investment plan do you want? And you may not necessarily have any idea unless you begin thinking about it now. Like, how much of your income do you want to go towards the 401k plan? Because sometimes they let you increase above and beyond the required minimum. And my suggestion is put in as much of it into the 401k as you can, because it's tax deferred in a way that is really advantageous. All right, so think about that project. We've got less than a month now. It's due on Friday, November 19th, and today's the 20th. So you've got less than a month to wrap your head around that project. And experience has told me that the students who start early are the ones who can overcome the uncertainty, and they can get their questions answered and figure out the spreadsheet's working right. But then the students who procrastinate and don't start the project until Thursday, November 18th, their reports don't look as good, and they're typically disappointed with the score that they earn. Any questions about the announcements or the project before we move on to incremental B2C analysis? Yeah.
Have you actually had somebody start it the day before and get it done?
Well, if they didn't start the day before, I would be shocked. Yeah, I have seen reports that looked like it was thrown together and just like continuous stream of thought, like no editing, just typing and then submit. It kind of seemed like that.
I know somebody that did, and they got an A apparently.
They got an A?
Yep.
Well, they fooled me.
They got
Let's see if you can fool me too. All right. I wouldn't gamble on it. They must be a genius or have a lot of prior knowledge, because one thing I'm especially picky on is whether the spreadsheet is functioning correctly. And you have to be calculating the accumulation of the cumulative savings balance. I'd say more than a third of the class typically gets that spreadsheet set up incorrectly, where the cumulative savings balance isn't being calculated in the right way. And so that's one of the first things that I look at when I'm grading each student's work is, it's just such an easy thing for me to assess whether the compound interest is being accounted for in that spreadsheet. All right. So incremental analysis. Remember, we're talking now about benefit versus cost. These typically public sector projects that are undertaken not just because they're profitable, but because they have some other social benefit. And so an example of one type of public project that has social benefit is flood control. Here in Huntington, we have flood walls that ring around the city to prevent the Ohio River from coming in and damaging structures in the city. And so a town could have a flood wall. Another approach that they sometimes follow to reduce flood damage is raising structures. You can see that this house is on, it looks like a bunch of wooden pallets. Hopefully that's just a temporary solution until they get something more secure. Another alternative maybe would be dewatering. And in New Orleans they have these big pumps that have the ability of pumping water out when it rains, because a lot of New Orleans is below sea level, so that when they have wet weather, or especially a hurricane, there's a real threat of flooding there. So incremental analysis is how we compare alternatives. What we talked about last time, the B to C criteria, what's the decision criteria for whether a project is justified when we do a benefit cost analysis? Do you know what is the rule to give a thumbs up or a thumbs down for a project? Yeah.
It's greater than 1.
Greater than 1. Exactly. So if it's greater than 1, it's a thumbs up, meaning you're getting more than $1 of benefit for every $1 of cost. So that will tell you if a project is acceptable, but if you have multiple projects, you can't just choose the one that has the highest B to C, because that won't necessarily be the project that is most advantageous. And maybe that seems kind of familiar, because we talked about something similar when we were discussing how you can't choose a project, a for-profit project, just on the basis of which one has the highest IRR. IRR is good for initial screening, but it won't tell you which is the best alternative. So you'd need to do an incremental analysis. Now, in the same way, when we're doing benefit cost, the way to know which alternative is best is to do these matchups. One option versus the other option, and find out what's the benefit to cost ratio on the increment. So this word increment means the difference between two options. That's what it meant back when we were doing incremental rate of return analysis, comparison between alternatives, how much extra does one option cost versus another option. So increment means the same thing here. When we're doing benefit cost, we'll stack up two alternatives, find out of the cheaper one versus the more expensive one, how much more expensive is that option B, and then we'll look at what are the incremental benefits that it provides, and then we will assess the difference. And if the ratio of benefits to cost of the difference is greater than 1, then that means you should choose the more expensive alternative. So we'll apply this same B to C formula at first for initial screening. We'll give a thumbs up or a thumbs down to each of the potential options, and if they pass initial screening, then we'll do these matchups and comparisons of the alternatives. So then for each of the alternatives, you'll find out what's the difference in cost between the two options, what's the difference in benefits, the difference in disbenefits, and then put those into this formula, and from that calculate the incremental benefit cost. And so the incremental benefit cost is not just the difference in B to C between two options. You have to put in the delta B minus the delta D divided by the incremental costs in the denominator. So this is what the formula looks like when we're doing the incremental analysis. The incremental benefit cost is just, you find the difference between options. You can do it for either modified or the conventional formula, and the decision criteria is that when the ratio is greater than 1, then you choose the more expensive alternative. And let's think about, why would that be? Why would you choose the more expensive alternative if the ratio is greater than 1? So what it means is, you've got option B and option A. Option B is more expensive. But what you found, if the ratio is greater than 1, you found that although it's more expensive, that extra dollar of cost gives you more than a dollar of incremental benefit. So it's like you're spending $1, but you're getting more than $1 of value back. So the rule is, keep spending money as long as that's the case. Anytime you can get more than $1 of value for each dollar that you spend, maximize your spending, because you're getting more than you're paying for. And sometimes that's the case. Like with flood control. If you can put in a flood wall and it costs $1 million, but then it prevents $3 million worth of damage, then it's worth building the flood wall. So that's what we're going to do today, is a couple of these comparisons. And when the benefit cost increment is less than 1, that means stick with the less expensive alternative. So you reject the more expensive alternative and stick with the previous best option. Because when the ratio is less than 1, that means you've got less than $1 of benefit for each dollar of cost. And you wouldn't do that. You wouldn't give me $1 so I could turn around and give you 50 cents. That would be a bad deal. All right. So today's in-class exercise. Let's pull up the handout and take a look at it together. I've sent you no, I haven't sent it, but it's available on Blackboard, the template file. So pull open the handout 25 and download the template file from Blackboard. And let's take a look at what we are analyzing here. All right, so this is a flood control analysis. We can build a dam, and it looks like that there are a couple of reasons to do that. To alleviate flooding, it's providing a source of water for fighting fires. Have you ever seen those airplanes that can skim across the water to scoop up water and then they fly off and dump it? So dams can be useful for a variety of reasons, and introduce recreational opportunities like boating, fishing, and that sort of thing. Okay, so those are some of the benefits, and you can see that for each of these 4 options that are being considered, we have quantified the flood control benefits, the fire protection benefits, and the recreation benefits that are attributable to each option. But it also has a downside. Of course, you have to pay money to construct it and also to maintain and operate each option over a 75-year time frame. So here, some of the costs are already in the present, and then everything else is already on an annual basis. So for us to put numbers into the formula, for us to put numbers into the B to C formula, the money has to be across the same time frame. So that means either move these present costs to an annual basis, or convert all of the annual amounts into present worths. Either one will give you the same answers. I typically convert anything that's annual to a lump sum present value. And that's what the solution will be in terms of when I bring it up on screen later on. But you can do it on the annual approach if you want. I guess here in the instructions I told you to do present worth. All right, so 6% discount rate. And what we want to do is, first of all, calculate the present worth of each of them, and then calculate the B to C ratio for purposes of initial screening. So let me bring open the template file that I've created, just so you can see how that file is intended to be used. Okay, so I've already filled in the costs and the benefits and disbenefits. Now, in part B, what it's saying is calculate the conventional B to C ratio for each of them. So here in this column, you're going to use the conventional B to C ratio formula to do some initial screening and find out of all of these options, are they each justified or should some of them be thrown out? And then in the incremental analysis, do you remember what was the process we followed in our previous incremental analysis? Like, how do we know which matchup is first? Go ahead.
The second cheapest minus the cheapest.
Exactly. That's right. So you're matching up the two cheapest alternatives that pass the initial screening. So you can see here I have comparison blank versus blank. You're not going to know which of the alternatives should be compared to each other until you know, do all of these options pass the initial screening? And if they do, then it would be the second cheapest minus the cheapest, just as he said. All right. So I'm going to stop talking for now, give you a few minutes to start to digest this problem and apply it into the template file that's created here. And I'll circulate around and answer any questions as they come up. Okay, let me pause you for just a moment if I can, because as I've walked around, I've noticed that a fair portion of people are making the same mistake. So I just want, it'll be most efficient if I just show everybody at the same time. Okay, so the initial costs are already in the present value. So all I need to do is equals and click on this cell up above and then carry it down through, because the initial costs were already present value. I guess I'll put in this 6% interest, and I'll put in the project life 75. Okay, now maintenance and operation, that's a recurring annual amount. There are 75 years where the maintenance and operation costs are $52,000 each year. So I want to know what's the present equivalent of that. So I'm going to do equals PV. The rate will be the 6% interest rate. Anchor the reference. N, 75 years, anchor the reference. Now, we're just so much in the habit of putting in a double comma. Maybe that's what you naturally did by instinct, but that would be a mistake. Because when you put in the double comma, that is telling the function that whatever amount you give it is a single future value. When in reality, what we have is 75 years of 52,000. Not 1 year, 75 years in the future. It's 75 of them. So I'm going to put this amount into the payment field. Of course, the minus sign, just because it always flips it. So I'm going to say take $52,000 per year for 75 years and tell me that the present equivalent of that. So this is what we have as the present value of those $52,000 each year. And then let me show you how you can do all of the benefits at the same time. Okay, so equals PV, rate 6%, N, 75 years. Okay, now we know that we want the flood, fire, and recreation all together. So the trick is that you could put, now I need to put in the comma and a parentheses. I'm going to say parentheses, this plus that plus that. And so now all of them are in that function. And let me just make sure I put that negative sign in. Okay, so what I'm saying is there's going to be 75 years where I've got flood control benefits, fire protection benefits, and recreational benefits. And I want to combine those three benefits together and then discount it to the present, the 75 instances of it. So $10,696,301 is the present worth of the benefits. And then same thing with these disbenefits. So PV, rate 6%, 75 years, and disbenefits, but the minus sign. Okay, so it's the double comma that would be a mistake in this case. All right, so I'm done talking for now. You can go back to your collaboration and independent work. Okay, we've got just enough time remaining for me to work through the solution and kind of talk through what I'm doing. If you want to continue working on your own thing, that's totally fine. If you want to check and see how I'm doing the solution, then that's great too. So I previously already had calculated the present worth of the maintenance and operation, the benefits, the disbenefits, and then calculated the conventional B to C ratio. So let me do that for option B as well. So rather than dragging it down, I'm going to type it in one more time just to illustrate. So equals PV, using our 6% interest rate, pressing the F4 button to anchor it. NPER, 75 years. I'll anchor the reference there. And then the amount goes into the payment field. So minus of the amount. Okay. Now for the benefits, PV, the rate, the N. And then for the payment, I'm going to do in parentheses the sum of this and that and that. So those all together are going to be the amount that it sees as a payment that's recurring. I have to put one more parentheses at the end. And then finally the disbenefits, PV, rate, N, and minus of the recurring annual disbenefits, and there's the present value. So the, did I click the wrong cell? Yeah, I did. All right, it's supposed to be for option B. So I can just drag that down, and now it's, okay. Conventional B to C ratio. So equals the benefits minus the disbenefits in the numerator, and then in the denominator, the initial costs and the maintenance and operation costs. Everything is on the same timeline, meaning at the present. So I'm just going to drag all the rest of these equations down for the two other remaining options. So all of the alternatives pass initial screening. They're all potentially suitable. Now, we can't just pick the one that has the highest B to C, because that won't identify the alternative that has the most benefit. So they're all suitable. So let me just put a conclusion here, an interpretation. Acceptable. Acceptable, acceptable, acceptable. That's the interpretation of this first analysis. All right. Now, the incremental analysis, I can't set all of the matchups at the beginning. I just know the first two options that are going to be compared. It's going to be B versus A. I can't know what the next round of comparisons should be until I know who won out of B versus A. So that's why I don't fill in all of the options yet. All right, so the delta C is just the more expensive option minus the cheaper option. So option B is $780,000 more expensive. The incremental costs, the incremental benefits. Of course, I could just drag sideways. I don't have to be keying all of this in. I could just drag sideways. All right. Now this is really important. The incremental analysis is not just the difference between these two. The incremental analysis is I do the same formula as before, but now with the deltas. That's what it means here in this slide. The delta B to C is you put the incremental amounts into the formula. Okay, so it is the incremental benefit minus the incremental disbenefit in the numerator. In the denominator, it's the incremental cost on an initial basis plus the incremental cost on the maintenance and operation. So 2.57. We need to interpret this. So what's the interpretation? Option B is better because it's more expensive, true, but for every dollar of additional cost, you're getting $2.57 of benefit. So you should definitely get the more expensive alternative. Okay, so B is our champion out of this matchup. That means our next comparison is C versus B. So C is the next most expensive alternative. So let's do C minus B. All right, this time I am just going to drag sideways, but I'm going to drag down here for the delta B to C. 96 cents. So option B is better. The more expensive alternative in this matchup is not justified because for each dollar of cost, you only get 96 cents of benefit. So our final matchup is going to be D versus B. All right, so D versus B. I can drag this sideways, drag this one down, and option D is the winner. Option D is best. Choose option D. It maximizes benefit. So we wouldn't have known that if we only looked at these conventional B to C ratios. But we do know that from the incremental analysis because we compared the alternatives. All right, that's all the time I have for you today. Remember that your next assignment is due on Monday, and I think you have an incremental benefit cost analysis. Save your work. Hopefully it'll be useful. And then long-term project due on Friday the 19th. All right, see you next time.